Ray Dalio, the bubble has already popped, you just don't know it yet. Ray Dalio, founder of Bridgewater, the world's largest hedge fund firm, has formulated a bubble indicator made up of 6 factors, including broad bullish sentiment and high prices relative to traditional measures. And according to him, the bubble has already been bursted. Dalio has around 50 years of experience as a professional investor, buying his first stock when he was just 12 years old. He founded the world's largest hedge fund firm, Bridgewater, in 1975 and built it into a $154 billion FUM business. The fund manager has returned an average of 11.5% a year over the last 28 years, which is almost double the average annual return of the S&P 500. Dalio has also gained fame partly for his radical philosophy and his simple steps for achieving investment success. Decide how much you can save, then create a diverse portfolio and learn the market's long-term cycles. His latest newsletter starts with a checklist of 6 things that distinguish a bubble. Updating his January note, the primary change this year has been the overextending of the bubble stocks, some of which have burst. Tech stocks have been widely regarded as being in a bubble. And on the key issue of whether the tech sell-off is finished, Dalio suggests no. Just because they're at a bubble extreme doesn't mean they're safe, or that it's a good time to get long. In fact, US stocks in aggregate still look overvalued by our measure, he said. Using some handy charts to illustrate, Dalio discussed the bubble slice. This shows how a basket of emerging tech bubble stocks perform versus the S&P 500 over various points in time. These are classic bubble conditions. Everything, down to the effect of tightening interest rises in the current environment, has echoes of the 1920s. Another of his standout comments was about the number of new buyers in the market as an indicator of a bubble. This gauge was shot above the 90th percentile in 2020 due to the flood of new retail investors into the most popular stocks, which by other measures appeared to be in a bubble. More recently, we have seen meaningful moderation in the pace of retail activity in the markets. It's now back to pre-COVID averages, said Dalio. On the point whether purchases are bought on leverage, Dalio explains how it provides an indicator of whether investor expectations are too optimistic. In the equity markets, I look at indicators like capital expenditure, whether businesses are investing a lot or a little in infrastructure, factories, etc. It reflects whether businesses are extrapolating current demand into strong demand growth going forward. This gauge is at the 40th percentile, similar to other gauges. What does this all mean? This isn't something that should change your broad investment strategy. The above view should only influence tactical changes. Either way, bubbles more often correct meaning sell-off more than the fundamentals would suggest versus just settling back to normal levels, but I wanted to pass along these updated readings to you in light of what's going on in the markets, Dalio said. Emerging tech stocks no longer appear to be in a bubble, said hedge fund mogul Ray Dalio. So, is it time to buy? For several years, many stock watchers have pointed to signs of bubbles in the market. In January, the bubble indicator showed that the United States equity market as a whole was at the edge of a bubble, but not an extreme bubble, he wrote in a commentary on LinkedIn. The market was 70% of the way towards the biggest bubbles, which occurred in 1920s and 1990s, Dalio said. His indicator also showed that emerging tech companies, Tesla Inc., Roku Incorporation, were clearly in an extreme bubble. In January, Dalio also cited problems with SPACs, the IPO boom, and the big pickup in options activity. I noted that other bubbly behavior financed by the unprecedented flood of liquidity post-COVID had found its way into the asset markets, Dalio said. At the time, the overall US stock market was at the edge of a bubble. In other words, 70% of the way towards the highest bubble, which happened in the 1990s and late 1920s, Dalio noted in a LinkedIn post on Monday. At the same time, Dalio highlighted other signs of froth, including the boom in special acquisition companies, or SPACs, the initial public offering boom, and a big pickup in options activity, which were all financed by the unprecedented flood of post-COVID liquidity that had found its way into the assets market. The bubble has popped. Now his bubble stocks have popped. They declined by about a third over last year, while the S&P 500 is about flat, Dalio said. In addition, there has been a meaningful decline in frothy retail activity and a meaningful deterioration in sentiment, he said. A bubble has burst for emerging tech stocks, but that doesn't mean it's safe or smart to go long on those names right now, warned billionaire investor Ray Dalio. That doesn't mean all is well. Emerging tech stocks no longer appear to be in a bubble, but neither do they appear to have substantially swung to the opposite extreme, so it's not necessarily true. that now is a good time to buy them, he wrote. Bubbles can take a long time to unwind, like 2 years in the case of the 1929 bubble, 1 year in the case of the late 1990s tech bubble, and typically go to the opposite extreme. So just because they aren't at a bubble extreme doesn't mean that they're safe or that it's a good time to get long, he said, warning that US stocks in aggregate still look overvalued. History shows that once the popping begins, bubbles more often overcorrect to the downside versus settling at more normal prices, Dalio wrote. Tell us in the comments if you agree with Ray Dalio. If you like this video, then press the like button and also tap to share. Share it with your investor friends. Also subscribe to our channel for more such interesting updates.